Imagine two investors entering the stock market at the exact same time. Both have similar incomes, similar goals, and access to the same information. Yet 20 years later, their financial outcomes look dramatically different. One investor quietly built substantial wealth, while the other barely kept up with inflation. The difference was not intelligence, secret knowledge, or even starting capital. The difference was patience. Patience in the stock market is not simply waiting. It is the ability to remain consistent while the system around you constantly tests your emotions. Prices rise quickly and people feel excitement. Prices fall sharply and people feel fear. And during long periods where nothing seems to happen, people feel boredom. These emotional cycles quietly shape investor behavior, often leading people to make decisions that conflict with the mathematics of long-term wealth creation. The stock market itself operates on a simple but powerful mechanism. Businesses grow over time. When a company increases its revenue, expands its products, improves efficiency, and earns more profit, the value of that company tends to increase as well. Stock prices, although volatile in the short term, often follow this long-term growth pattern. This means that investors who stay invested long enough allow business growth to translate into financial growth. However, the human mind struggles with long time horizons. Our brains evolved to respond quickly to immediate threats and rewards, not to patiently observe slow compounding processes over decades. When markets drop suddenly, the psychological discomfort can feel intense, even if the long-term fundamentals remain unchanged. Many investors respond to this discomfort by selling during downturns, effectively locking in losses and interrupting the compounding process that requires time to work. To understand why patience matters so much, it helps to examine the mathematics behind long-term investing. Consider a simplified example where an investor earns an average return of 7% per year. In the first few years, the growth appears modest. A $10,000 investment grows slowly at first, perhaps reaching $14,000 after 5 years. But as time continues, the growth begins to accelerate because each year's gain is applied not only to the original money, but also to the previous gains. After 10 years, the same investment grows to nearly $20,000. After 20 years, it exceeds $38,000. The increase between year 10 and year 20 becomes larger than the entire growth of the first decade. This accelerating effect is the mathematical engine behind long-term investing, often referred to as compounding. The key detail is that compounding requires uninterrupted time. When investors panic and exit the market during volatile periods, they effectively reset the clock. Instead of allowing growth to accumulate, they pause the process and may even miss the strongest recovery periods that historically occur soon after downturns. Market history repeatedly demonstrates this pattern. Periods of decline are often followed by periods of recovery, yet the timing of those recoveries is unpredictable. Missing even a small number of the market's best days can significantly reduce long-term returns. Investors who attempt to move in and out of the market based on short-term predictions frequently discover that predicting those turning points is extremely difficult. Another important aspect of patience is behavioral stability. When investors check prices constantly, every small movement feels important. A 5% drop might appear alarming when viewed daily, even though similar fluctuations are normal in long-term market behavior. Patience allows investors to zoom out and see the broader trend rather than reacting to every temporary change. This perspective shift changes how volatility is interpreted. Instead of seeing price swings as threats, patient investors begin to see them as normal features of the system. Businesses do not grow in straight lines. Economies experience cycles, and markets reflect those cycles through fluctuations. Patience accepts this variability as part of the process rather than a signal to constantly intervene. Historically, many of the largest market gains occurred after periods of uncertainty or pessimism. When economic news appears negative, stock prices may temporarily decline, even though the long-term productivity of businesses remains intact. Investors who maintain patience during these periods often participate in the eventual recovery, while those who exit early may struggle to re-enter at the right time. Another psychological factor influencing patience is comparison. Investors frequently compare their portfolios to others, especially during periods when certain stocks rise rapidly. This comparison can create pressure to abandon long-term strategies in favor of short-term opportunities. However, chasing rapid gains increases risk and reduces stability, especially if the underlying investment decisions are driven by emotion rather than analysis. Patience also changes how investors interpret time itself. Many people approach the stock market with expectations of quick results, measuring success over months or even weeks. Yet the market's true strength emerges over decades, not days. When investors align their expectations with the long time horizon required for compounding, the entire experience becomes less stressful and more systematic. In this sense, patience is not merely a personality trait, but a structural advantage. The stock market rewards those who allow time to amplify growth, while it often penalizes those who repeatedly interrupt that process through emotional reactions. The system quietly favors consistency over activity. This principle explains why many long-term investors adopt simple strategies rather than constantly searching for complex predictions. By focusing on consistent investing, diversification, and long holding periods, they allow the underlying economic growth of businesses to work gradually in their favor. Over time, patience transforms from a passive act into an active discipline. It requires resisting the impulse to react to every headline, every sudden price movement, and every short-term trend. It means understanding that volatility is temporary while compounding is cumulative. When viewed through this lens, the stock market becomes less about predicting the future and more about participating in a long-term economic system. Investors who remain patient effectively align themselves with the gradual expansion of businesses, industries, and productivity across decades. And that alignment with time may be the most powerful advantage the stock market offers.